Good evening and welcome. My name is Aaron Burt, and I am a certified financial planner with the Certified Financial Group in Altamont Springs. This is the first of a series of webinars that Certified Financial Group University, or CFGU, will be presenting. At Certified Financial Group, we developed this concept of CFGU to help provide general education to the public about investment topics, and in doing so, hope to become your resource for all things financial. This webinar will be recorded and posted to our website with all of the future webinars as they occur. We will be taking questions during the presentation, but we'll be answering them offline, so feel free to type questions in the chat box or shoot us an email after the webinar is complete, and we'll be more than happy to answer any questions you may have. This first presentation is called Investment Basics 101, and we're going to discuss the basics of investment planning. We'll start by discussing some fundamental concepts, and then we'll review some investment options that are available to you and consider some general investment strategies. Finally, we'll spend some time discussing how you might go about allocating your investment dollars. And in the end, I hope that this overview will assist you in thinking about your own investment needs and may help you determine whether you may benefit from working with a certified financial planner professional. So let's begin. First, let me pose a question. What does investing mean to you? So some of you may associate investing with speculating or gambling on a volatile or uncertain value of assets in the hope of obtaining potentially higher returns. For example, trying to time the market in order to make a quick profit. And others may see investing as more of a long-term, methodical effort to save for the future. And in fact, investing is a little bit of both. All investing involves a certain amount of risk, including the potential loss of principal. And there can be no ironclad guarantee that any investing strategy will be successful. Investing also involves the potential growth of your money over time. So consider investing a carefully planned and prepared approach to managing and accumulating money. Investment planning is about discipline and patience, but it doesn't have to be difficult. So an important concept to understand when it comes to investing is the impact of inflation. Inflation has the effect of reducing the purchasing power of your dollars over time. According to the U.S. Department of Labor, the average annual inflation rate since 1914 has been approximately 3%. So at a 3% annual inflation, something that costs $100 today would cost $181 in 20 years. Think about that for a couple minutes. Well, maybe not minutes, but seconds. That's a lot. I mean, your purchasing power is definitely going down. But let's look at it from a higher point of view, more money. Let's say you have $200,000 stashed in your mattress. Assuming a 3% annual inflation rate, that $200,000 will buy you just over $108,000 worth of goods and services in 20 years, and less than $60,000 in purchasing power in 40 years. This means that if your investments aren't keeping pace with inflation, you're actually losing purchasing power each year. It also means that the real rate of return on your investments may actually be less than you think, something you'll need to take into account. Inflation has the general effect of reducing the real value of your investments over time. But compounding has exactly the opposite effect. Anyone who has a savings account understands the basics of compounding. The funds in your savings account earn interest, and that interest is added to your account balance. The next time interest is calculated, it's based on the increased value of your account. In effect, you earn interest on your interest. And many people, however, don't fully appreciate the impact that compounded earnings can have, especially over a long period of time. Let's say, for example, you earn $5,000 a year for 30 years. After 30 years, you will have invested a total of $150,000. Yet assuming your funds grow at exactly 6% each year, hypothetically, but because of compounding, after 30 years, you will have over $395,000. A very quick rule of thumb is called the Rule of 72. It's a quick way to help you estimate how long it will take for an investment to double in value through compounding. Basically, you divide the number 72 by the rate at which the investment will increase in value. The result is the number of years that it will take for the investment to double. So for example, if the expected annual rate of return on an investment is 3%, it would take about 24 years for the investment to double in value. You can also use the rule of 72 to estimate the rate of interest you'll need to double your investment in a given number of years. So you just take 72 and divide it by the number of years. So for example, in order for an investment to double in value in 4 years, you would need an annual return of 18%. So the sooner you start investing, the more time your investments have for potential growth. However, waiting too long can make it very difficult to catch up. So for example, you invest $3,000 at the end of each year, starting when you're 20 years old. You you will have accumulated almost $680,000, assuming a 6% annual growth rate and no tax, by age 66. And if you wait until age 35, investing $3,000 annually, you'll accumulate only about $254,000. And if you wait another 10 years and start at age 45 to start investing, you'll accumulate only about $120,000 by the time you're 66 years old. It's a huge difference starting early versus waiting. However, it's never too late, so don't be discouraged. I'm simply trying to illustrate the importance of acting sooner rather than later. So the first step in any investment plan is to identify your goals. What are you investing for? Many of us invest to accumulate funds for retirement or for a child's education, and still others invest for shorter-term goals, perhaps a down payment on a house or a new car. Still others invest to build a fund that they can access for unanticipated financial needs, illness, accident, job loss, etc. Of course, you may have all of these things as investment goals or something that I haven't even mentioned. But if you do have multiple investment goals, think about how you might prioritize them. Now, once you've identified and prioritized your goals, consider the time horizon associated with each goal. Because generally speaking, all else being equal, the longer your time horizon, the more aggressively you should or can be willing to invest. That is, investments that carry more risk and therefore potential greater return will tend to be more appropriate for those with long-term investment horizons versus those with short-term investment horizons. Why is that? Well, the longer the investment horizon, the more time you have to recover from any potential investment losses. The world of investing is very subjective. The investment plan that's right for you depends largely upon the level of comfort that you have when it comes to risk. You can't completely avoid risk when it comes to investing, but it is possible for you to manage it. There are two aspects of risk tolerance to consider. First of all, the capacity of your investment plan itself to absorb losses, and secondly, how comfortable you are personally with risk. The first aspect can be quantified. Basically, the more flexibility you have in your investment plan when it comes to potential loss, the more risk your plan can tolerate. For example, if you have a long investment time horizon, it does allow you to take on more risk than if you have a short time horizon. The second aspect, how comfortable you are personally with risk, is more of an emotional measure and depends on many factors, including your objectives, life stage, personality, and investment experience. Some investors are comfortable with a high degree of risk, while others can tolerate only minimal risk. Your individual risk tolerance is an important factor in deciding which individual investments are appropriate for you, as well as how your investment dollars should be allocated among different investment classes. Investors are typically grouped into three categories for purposes of discussing risk: aggressive, those who have a high degree of risk tolerance; moderate, and then conservative, those who are risk adverse. So moderate would be between aggressive and conservative. You're willing to take some risk, but not a ton. Now, when it comes to investing, there's a direct relationship between risk and return. That is, in general, as the potential for return increases, so does the level of risk or volatility. Or stated another way, the less risk an investment has, the lower the potential for return. So, for example, putting your money into a bank CD may have little risk, but it also offers less potential for return than purchasing common stocks. This is true for investment portfolios as well as for individual investments. The more aggressive you are as an investor, the more risk you may be willing to take. More risk means a greater potential return, but also a greater chance of loss. Conversely, the more conservative you are as an investor, the less risk you're generally comfortable with, and less risk basically means less potential return, but less risk also means less likelihood of loss. This is known as the risk-return trade-off. As much as we would like it, we can't have it all. There is a relationship between growth, income, and the stability of our investments, and when we move closer to one, we automatically move away from the other. This is the dilemma that all investors face. The key is to try to maximize returns at a level of risk that you're comfortable with. Now, there are several general categories of investments to choose from, and countless specific investment options within each category. So we're going to discuss cash alternatives, bonds, stocks, other investments, and funds that pool your money with other investors, such as mutual funds or exchange-traded funds or ETFs. But before we start talking about investment options, let's take a moment to clear up a common misconception. And actually, we see this a lot. Some of you think that your 401k plan at work is an investment. It's not. A 401k plan is a tax-advantaged vehicle that holds individual investments. The same goes for IRAs, 529 plans, and Coverdell educational savings accounts. These are tax advantage vehicles, and they're buckets that can be filled with individual investments. Investments that are held in these vehicles get different tax treatment than investments that are held outside of these vehicles. So we like to think of it like a shopping cart. An investment vehicle is basically your shopping cart. You walk through the store, you can put all sorts of different investments or groceries or products inside that cart. The vehicle itself, the 401k, the IRA, it's basically just the cart, and the investments are what you're putting into it. But we're not going to talk about the tax treatment of those particular types of investments today, but it is an important subject, especially since the tax treatment of long-term capital gains and qualifying dividends is typically more favorable than that for ordinary income. And since you'll need to understand how different investment options are taxed to make good decisions, you should discuss this issue with a financial or tax professional. Cash alternatives are relatively low risk, short-term, and generally fairly liquid. In other words, you can convert them to cash quickly if needed. You might use cash alternatives to provide you with stability, to maintain a ready source of cash for emergencies or other purposes, or to serve as a temporary parking place for assets until you decide where to put your money longer term. A few examples of some cash alternatives include certificates of deposit, money market deposit accounts, money market mutual funds, and U.S. Treasury bills or T-bills. Each option offers different rates of return and varying levels of liquidity. Also, some cash alternatives, such as bank CDs and deposit accounts, may offer FDIC insurance, and others do not. Be sure you understand the type of protection available with each one. The advantages of investing in cash alternatives are evident. You receive reliable, predictable earnings, or interest, in an easily tapped source of funds with little risk to principal. The big trade-off here, though, is that you'll return very little because those investments return relatively low compared to potential return offered by other investment options that we'll talk about in a minute. In fact, the possibility exists that the return on these investments will not be sufficient to keep up with inflation. If that's the case, you'll actually lose purchasing power over time by holding these investments versus others.